the industry. So Mr. Adetola Akinsulire, I hope I pronounced that correctly.
That's a good one. That's a good one.
Thank you. Thank you. So he's a subject matter expert when it comes to mortgage loan and in particular MRIF. So I would allow him to introduce himself and blow his trumpet by himself. And please don't be humble.
Okay, thank you very much, Kemi. Pleasure to be here with everyone. Just a bit about myself. My name is Tola Akinshile. I'm the Group Chief Commercial Officer of Mixter Africa. My career has had me working across French-speaking, English-speaking, and Spanish-speaking countries across Africa and Nigeria. My interest is very much in real estate, and beyond just doing the projects, I've also been involved in policy formation across both Nigeria and other African countries. So I think that's the quick overview I'd like to give about myself. Yeah, thank you.
You're welcome. Please speak to the fact that you were part of the committee on MOFI
Okay.
stringing together MRIF.
Okay. Yes, I was part of the implementation team working with the Ministry of Finance Incorporated to get this framework, the Ministry of Finance Incorporated Real Estate Investment Fund, up and rolling. So in terms of helping to midwife what we currently have today, I was part of that team. Yeah. So that's much I can speak in terms of at least having a behind the scenes look of what has evolved into what we currently operate within the markets now.
Fantastic. Thank you. Welcome once again. So I'm sure a lot of people would have been hearing MRIF. MRIF, which one is MRIF again? Single digit interest. Please just give us a brief background into what MRIF is in particular.
Okay, I think the easiest way I can go about this is to actually start from something that people are familiar with. I'm sure literally almost everybody is familiar with the National Housing Fund, the NHF, which is run by the Federal Mortgage Bank of Nigeria, which allows people to be able to get single-digit mortgage, and which is operated primarily to the PMIs. Now, we're already familiar with how that operates, whereby you basically approach your PMI, and then your PMI applies on your behalf to the Federal Mortgage Bank, and then you're able to access it. This is more or less the same structure in terms of how it operates. The difference here is this: unlike the National Housing Fund, whereby you need to have contributed for at least about 6 months before you are eligible to it. For the MRIF, it's completely different. You don't need to make contributions. It's a different approach. So unlike the NHF, whereby the way in which they generate funds is largely through the contributions of every one of us. So I know for some of you, depending on the companies where you are working, you actually have monthly deductions that are being made towards the NHF. The difference with the MRIF is that the MRIF, instead of waiting for every one of us to make contributions and pull the money together, what the MRIF has done is that it has actually sourced funding. The fund is registered with a 1 trillion naira value in terms of that's what it's registered for SEC. And so far, it's been able to raise about 250 billion. 150 billion from the federal government and about 100 billion from private investors comprising of PFAs, banks, insurance companies. And so the advantage of the MRIF is that it doesn't need to wait for you to contribute before it has funding to be able to disburse mortgages. It has that funding from having raised the money. So it started with about 250 billion, and it is that 250 billion that is disbursing towards mortgages. So it works through the same system that already exists in the market. So if you want to get those mortgages, it's not that you go directly to the MRIF. You actually go directly to either your PMI or commercial banks. And the PMIs and the commercial banks, they will do their traditional credit assessment. And once they qualified you as being able to take that mortgage, all they will simply do is just make that request to MRIF. And MRIF, who already has a fund, is now going to disperse the money to the commercial or mortgage bank, and they will now disburse the mortgages directly to you. So that's just like a simple overview of how the MRIF works. You're muted.
Oh, sorry. Thank you for that breakdown. So MRIF is very, very much different from NHF. That means if you start work today, for instance, you can actually take MRIF. Is that correct?
Yeah. Well, okay. So if you start work today, you cannot take MREIF because let me just run you through the way it is. Most financial
Okay.
institutions, they would like to see your credit history. So
Mm,
your banking history, your employment history. So you can't immediately from day one that you start working to expect that you're going to get. But basically, they would want some sort of history in form
mm,
of part of the requirements they would ask for you when you want to get the mortgages. They would ask for your bank statements. They would ask for your previous pay slips at least for about, I think between, depending on the institution, between 6 to 12 months, depending on the institution. So
mm,
you have that. But bottom line here is this, you don't need to have contributed towards that, towards a pool of funds, as against what happens with NHF, whereby you need to have been making contributions. With MRIF, as long as you can meet the minimum equity contribution to buy the property that you want and you meet the assessment criteria of the financial institutions, you can access your MRIF mortgage.
okay. Thank you very much for that. So, some Nigerians in diaspora, when they want to get mortgage to buy homes in Nigeria,
Yeah.
they have to go through NIDCOM.
Okay.
How does that work with MREIF? Is that a separate process on its own, or you can forget about that to come directly to your commercial bank and take MREIF to purchase a home as a Nigerian living abroad?
Okay, so the NIDCOM is an initiative which is driven by the Federal Mortgage Bank of Nigeria. And the whole idea is to try and help diaspora people be able to access mortgages to acquire property in Nigeria. For you to be part of that, you need to have contributed for at least 12 months. But like I said, that goes through your your sorry, that goes to the NHF Bank, the Federal Mortgage Bank of Nigeria. That goes through that institution. Now, the current practice under MRIF here is this: under MRIF, if you are in the diaspora and you want to access mortgage, what you have to walk through is you have to walk through a commercial institution that already offers diaspora mortgages. So there are certain financial institutions, because of the relationship that they have, whether they have a strong correspondent bank in some of these countries like the UK and especially really the UK and maybe the US, what they are able to do is they are able to offer mortgages to people who are in the diaspora. So what would typically happen here is that if a commercial bank or a mortgage bank is already comfortable with offering diaspora mortgages, all they will simply just do, just the same process, they just package your own credit and they present it to MRIF, and MRIF is going to disburse to them. Like I said, MRIF deals directly with the financial institutions. They are basically funding the financial institutions. And really for them, as long as the bank is comfortable with taking that credit risk, the MRIF really is not so much interested in that aspect of it. It's the financial institution that defines how that works.
Hmm, fantastic. Okay. So does the 25% RSA play any role in this mix?
Yes, yes. So, and I think this applies to literally every financial institution that is currently operating the MRIF scheme. Yes, they would help you. A lot of them would help you access your 25% RSA contribution towards meeting your equity contribution on the property. So yes, you can use your 25% RSA contribution to meet the equity contribution that you need to make on your property.
Wow, that's a beautiful one, if I must say. So I think that sort of even takes care of the 10% equity, the now 10% equity.
Yes, the now 10%.
Yeah.
This is effective last week. Effective last
Okay.
week. So I would say this is one of the beauties about the MRIF. So just to give a bit of understanding to in terms of the operation of the MRIF. So the MRIF is largely a PPP initiative. So you've got private sector and then you've got the government also involved in it. So what did the government do? The government provided startup capital, and at the same time they created a enabling framework to ensure that this initiative kicks off. And what they did is they handed it over to the private sector. So you have a fund manager. And
Mm-hmm.
let me just say the simplest way for you to understand how MRIF work is just to look at the structure of your pension fund administrators, whereby you have a pension fund manager, you have a trustee, who holds the assets.
Okay.
You've got your financial institution that holds the liquidity and everything on behalf of it. So just that same structure is what is being replicated, or has been replicated with MREIF. So you have a portfolio manager who is responsible for managing the assets of the MREIF. So in terms of making disbursements to all the financial institutions, they're responsible for making sure that all that happens per and when it needs to be made. And because of that private sector involvement in it, you now find out that, look, there's a continuous adjustment to whatever is happening in the market. So, for example, when the fund started, the MREIF fund started, it started offering at 12%.
12%, true.
Yeah, it was 12% at 20% equity contribution. Later on, after a few months of running it, by the time it was able to see how the market was going, it was able to adjust interest rate from 12% to 9.75%. And then last week, it moved down equity contributions from 20% to 10%. So that's one of the beauty of having private sector involvement in it. You can adjust whatever levers you need to move within the context of the framework that established the fund. And it's self-regulated. So it already has a defined asset allocation, which it has to keep toward, because SEC is going to always be checking on that. So in terms of security of the funds which the investors invested in it, at least they ensure that there is a regulatory oversight to ensure that level of independence from your typical government initiative.
That's fantastic. And I even think that the recent bill on insurance would provide some more security, I guess, to this MREIF mortgage instrument. Will that be correct?
Well, what I will tell you here is this: a lot of a lot of financial institutions already include insurance as part of the prerequisites when they are about to sign the mortgage facility. So, for example, some even require you to take even term insurance, so that in the event of maybe you have, if you pass away or there whatever it is that happens, at least there's some sort of cover to be able to cover the payments that need to be made on your property. So bottom line here is this: whatever has happened on the insurance side, interesting. I was actually having a conversation with an insurance practitioner sometime last week, and he was telling me that, look, this is all part of some of the things that will really, really lay the strong foundation for having a multi-trillion naira economy. So, I mean, it can only enhance the value of what it is that you're already doing in the real estate market.
Absolutely. Absolutely. Wow, that's fantastic. Okay, so I have been seeing some MRIF, some articles on MRIF. I would see MRIF logo and then I would see ARM. Can you please speak to that?
Okay. So like I explained, ARM is the portfolio manager. So they
Okay.
are responsible for ensuring that the fund keeps to the asset allocation. They are responsible for the day-to-day operation. So, for example, let's imagine your financial institution wants to make a request to MREIF. They basically send that request to the fund manager, ARM. So,
Okay.
in terms of covering all the expenses of the fund and everything, it's the responsibility of the fund manager. So, just look at it as a PFA. So this is the
Okay.
PFA that is managing the funds
The
of
fund. Wow.
which the investors have basically contributed towards the providing mortgages.
Okay. Wow, that's good to know. And that gives some level of comfort, I believe. So that means the commercial banks and the PMIs, we can quote and unquote report them to ARM. Will that be the case?
It is actually interesting. Yes, you can, because interesting, something actually happened today. So there was an article which I wrote the when the fund said they had adjusted rates from 12% to 9.75%. And it was supposed to also affect the rebasing of previous mortgages that have been issued. So, for example, someone who had taken a mortgage at 12%, the next month after, his mortgage was supposed to be rebased to 9.75. So somebody actually reached out to me and was like, oh, that his PMI told him that no, that he's not going to be qualified for it. And I was like, no, that's not it.
Wow.
So I just told him that very easy. So I just got the contact information. I just got the contact of the person in AIM who handles that. I just said, look, send an email to this person, provide your details to the person. and is going to follow up with the institution to make sure that, look, they keep to the terms of it, because ARM has already indicated to all the institutions that, look, you need to rebase effective from 1st of August.
Oh, okay. Wow, that's good to know, and really good to know, I must say. So, okay, should I ask this question or not? All right. So, a few developers have reached out to me after seeing this flyer, and they're asking, where do they belong in this whole value chain? Especially those who are doing off plan, or maybe they have gone 50% on their project. What is the process for them? Can they even find their feet at all? Can they be qualified, if at all?
Well, so I think the question here is this: it really the most important party who decides what sort of mortgage financing I want to provide on a particular facility. It really depends primarily on your on the financial institution. So I know there are certain cases with certain financial institutions whereby they don't have to wait until a property is 100% complete. There are certain financial institutions who decide that, look, once a property has reached a particular level of completion, depending on the level of equity which the buyer is contributing or has contributed, the financial institution will be willing to take that. Okay, that's no problem. I will disburse the balance on the mortgage. So a lot really depends on the financial institution involved. And to say the point here is this: depending on the scale of opportunity that the financial institution expects that they'll be able to get from a developer, they might be willing to concede certain basis to them that, look, okay, if you are up to this particular point, okay, we are willing to extend that level of credit. But like I said, that decision really lies with the financial institution in terms of, okay, how well whether they want to bring them into that ecosystem at that stage of construction.
Okay, that's fantastic. I think we have pretty much covered a lot, despite the time constraints and the technology constraints that we had. So I'm particularly happy to know that, and I know because I have ongoing concern for MREIF. I know it's a much more simpler and seamless process, unlike the NHF, which they say is 6%. I don't know if, in fact, they should even they should come and learn from MREIF so that they can adjust whatever conditions have made that particular mortgage inaccessible. So we've been able to cover a lot, and when I mean a lot, yes, a lot, and I'm very grateful for that. So the elephants in the room for most people have been, how much exactly will I be paying? Maybe per month, or maybe some people are even saying, okay, don't restrict me to 33% of my monthly take home. I want to be able to pay more so that I can pay down quickly. Now, is it different with MRIF? Because I think NHF has that particular rule that it is either 33% or nothing. Is it flexible with MRIF?
Okay, so you asked a question. I mean, you asked a rather interesting question. And so let's go back to the foundation of that 33%. The foundation of that 33% is that, look, you should be able to still live conveniently, covering the rest of your expenses in life after you have been able to pay for your shelter. So whether it is rental or whether it is mortgage, which is the reason why that 33 point something percent cap is adopted. And you find out that with almost every financial institution, in all standard mortgage terms, and this is not only restricted to NHF, they definitely would like to restrict it to 33%. And what a couple of financial institutions have tried to do to sort of make it easier is, for example, if you have a husband and a wife, then they decide that, look, you can actually do a joint mortgage. Meaning that what they will now be assessing is they will be assessing both of your salary rather than just assessing one person's salary. So that way it gives you the room for you to be able to pay a lot more as against what you would have paid if it was just one. But that 33 point something percent is also a risk management strategy, which all institutions adopted. So it's not just tied to just NHF. If you go and meet any financial institution, they would always like to keep that cap around that. So there's no financial institution that you'll be able to waive that. The only way I can see you waiving it is, for example, if you have a spouse who also has a salary income, then you can decide you want to make it a joint mortgage, and then you'll be able to raise the amounts that you want to be making so that you can accelerate pay down on the mortgage.
Mortgage, okay. Well, I'm happy you spoke to joint repayment. Is it also possible that a couple can come together and take, so maybe the husband takes 100 million and the wife also takes 100 million? Is that a possibility?
As long as it is or not on the same property. So let's look at it this way. You can take 100 million, the husband can take 100 million from a different property, the wife can take 100 million from a different property, but you cannot take combined 200 million on the same property.
Okay, okay. So to the person who asked that question, I hope you have gotten the response. Does anybody have any other question before we call it a wrap? We have 8 more minutes from this link.
Good evening.
Good evening.
Yeah, just Mr. Kintu, thanks for the presentation. Just some few quick questions. Is there a cap on the type of building I can access? Can you hear me?
Yes, I can hear you. Go on.
Yes,
Go
I
on.
can hear you.
Okay. Yes. Is there a cap on the amount of building I can access for mortgage? That's one. And then are there specific areas or developers? I'm assuming if I'm not in Lagos, I'm somewhere in Osogbo, Osun State. Does it qualify for anywhere in Nigeria? That's my second question. Then do I have to be a salary earner before I can access mortgage? I'm saying I'm self-employed. I run a business, and where will I be classified? And then in terms of default, is there an ombudsman to run to solve whatever issues that is happening? And then amortization for how long?
Okay, so you've asked a whole lot of questions. So let me just run through all the questions. First and foremost, there is no restriction on the type of property that you can bring into the fund. You can use mortgage. The one thing I know here is that generally financial institutions prefer finished properties. They would rather prefer completed properties. Some are willing to take semi-finished, maybe like a hybrid finish, whereby there are still some few things happen. So it really depends on the level of exposure that a financial institution is willing to take. But there's really no restriction to the type of property that you can bring into the pool. Second thing about whether it is location dependent. No, it's not location dependent. As long as you live within the confines of Nigeria, you can always access the mortgage. That's it. As long as you are within Nigeria, you can always access the mortgage. And to the point about whether you can do it as a self-employed, yes, there are a couple of financial institutions that actually do it. So there's a separate requirement that they would ask for. If you are self-employed, they would ask for the bank statements of your business, all those sort of things. So each bank has their own, and most of the banks, the guidelines are more or less the same thing. So all you just need to do is provide that information. Yes, as a self-employed, you can also you can access it. You just need to meet the requirements which the financial institutions provide. In terms of, you're saying in the event of a default, if there's an ombudsman, I will not speak to that because I don't know that level of detail. You understand? So unfortunately, I don't have an answer for you in that regard. So I hope I've been able to address your other questions sufficiently.
Yes, but amortization.
Oh, amortization. Yeah, the maximum number of years is 20 years. So it's all a case of how the bank assesses your risk. If the bank is willing to go as much as 20 years, better for you. So it depends on how the bank assesses their risk of you in terms of, okay, what's the number of years that you still have to be able to make income, and on the basis of which they will define how long they think you'll be able to continue to pay for the mortgage. But the maximum under MREIF is 20 years.
Has all your questions been answered?
Yeah. So no, I cannot give all the questions.
Okay, thank you very much. And with respect to the ombudsman, I am guessing that every disbursing bank also have their way of recovery and maybe comfort, which they would request for. Will I be correct to say that?
Yes, there's a process. There's a process which that runs with in terms of recovery, and it still has to go through the court system. I know one of the things which we considered at the beginning of the whole scheme was if it was possible to find a simpler approach. But of course, because each state has different rules, different guidelines, we're still trying to work in terms of consolidating something, a framework that makes it simpler. But for now, there's no simple approach to addressing that.
Okay, we will do our best not to default.
Noted.
So we'll make the work harder. So we have 3 minutes left. Once again, I want to sincerely apologize for the delay in starting and for the mix-up. So I was raised not to overshoot time for any event, but unfortunately, technology showed us that it is technology. So thank you everyone for joining. Thank you, Mr. Tola, for the patience. Thank you everyone for the patience. So he's very active on LinkedIn. I just only hope that if you ask questions directly, he will be able to have time to answer, because I'm sure he will be getting tons of questions from people. And if you have any question, of course, everybody here knows that I'm always available to answer questions that has to do with owning real estate in Nigeria. Thank you everyone for your patience. And please let me also request that we'll be having another session very soon. So please consider this an open invite, Mr. Tola. And I believe that you would also grace that knowledge sharing occasion. And to everyone here, you are free to do research, gather your questions. You can even attempt to start this process with some of the commercial banks, so that whatever challenge you're experiencing, you can bring it on board the next knowledge sharing session. And I'm sure that Mr. Tola will be here to do justice to all the questions you may be having. Thank you once again, everyone. Thank you, Mr. Tola, and have a good evening, everybody.
Thank you. Thank you. Pleasure to have been here. Thanks.
Thank you very much. You're welcome.